Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Eli Lilly was founded in 1876 by Colonel Eli Lilly in Indianapolis. From the very beginning, the company aimed to produce medicines using rigorous scientific standards rather than folk remedies.
That commitment paid off in 1923 when Lilly began the world's first commercial production of insulin, a discovery that transformed diabetes from a death sentence into a manageable condition.
Lilly didn't stop there. In 1982, the company launched Humulin, the world's first recombinant DNA medicine, cementing its place at the frontier of pharmaceutical manufacturing technology.
The business today is organized around four main areas: cardiometabolic disease, oncology, neuroscience, and immunology. Cardiometabolic is by far the largest, representing well over half of total revenues.
The cardiometabolic franchise is anchored by Lilly's GLP-1 and GIP receptor agonist medicines. These drugs work by mimicking natural gut hormones to regulate blood sugar and reduce appetite.
From a financial standpoint, Lilly's margins have expanded dramatically as its high-priced specialty medicines scaled. Operating margins have climbed toward 30%, well above the pharmaceutical industry average.
Lilly reinvests roughly 21 cents of every revenue dollar back into research and development. That intensity is the engine that keeps the pipeline full and helps fend off competition.
On the balance sheet side, Lilly has committed tens of billions of dollars to expand manufacturing capacity. Building out supply infrastructure at this scale is a major barrier for any potential rival.
The company holds a deep patent portfolio covering active molecules, drug formulations, and delivery devices. These overlapping layers of intellectual property extend the effective protection window well beyond a single patent date.
Lilly's dividend has grown consistently over more than a decade of consecutive annual increases, though the yield sits near the lower end of the pharmaceutical peer group, given the company's premium valuation among large-cap drug makers.
In the competitive landscape, Lilly's closest rival in the GLP-1 space is Novo Nordisk of Denmark. These two companies are often described as competing in a race where demand outpaces supply.
Beyond GLP-1, Lilly's oncology division markets targeted therapies and has built out a clinical pipeline with multiple late-stage compounds, providing a potential runway for growth well past current blockbusters.
David Ricks has led Lilly as chief executive since 2017. A long-tenured insider, Ricks spent 2 decades in the company before taking the top seat, rising through U.S. and international commercial roles.
Under his tenure, Lilly has accelerated its pipeline-driven strategy, completed targeted acquisitions, and invested aggressively in manufacturing, a combination that repositioned the business for durable, decade-long growth.
Lilly today operates manufacturing and research facilities across 4 continents, with medicines reaching patients in more than 125 countries through a broad commercial distribution network.
The company's scale gives it negotiating leverage with payers, regulatory familiarity across major markets, and the ability to fund the enormous clinical trial programs that bring new medicines to patients.
That's the company chapter for Eli Lilly. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Eli Lilly reported Q1 2026 revenue of $19.8 billion, up 55.5% year over year. Adjusted EPS of $8.55 topped the $8.43 estimate by 1.4%. Zepbound and Mounjaro are now the defining drugs of this pharmaceutical cycle. The stock surged 10.5% post-earnings. Analyst average target sits at $1,287, 38% above the current price.
Eli Lilly and Company is an Indianapolis-based pharmaceutical giant founded in 1876. It is the largest pharmaceutical company in the United States by market cap at $882.8 billion. Lilly's portfolio spans diabetes, obesity, oncology, immunology, and neuroscience. The company's transformation from a mid-tier pharma into a mega-cap growth engine is almost entirely attributable to tirzepatide, the active ingredient in both Mounjaro and Zepbound, a dual GLP-1 and P receptor agonist.
Lilly trades at 27.1 times forward earnings, a meaningful premium to traditional pharma. Beta of 0.5 reflects its defensive growth hybrid character. The dividend yield is 0.67%, modest but growing. CEO David Ricks has led the company since 2017 and has overseen the full tirzepatide development cycle from phase 1 through regulatory approval and commercial launch across multiple geographies.
Revenue of $19.8 billion beat consensus and grew 55.5% year-over-year. Adjusted EPS of $8.55 beat the $8.43 estimate by 1.4%. GAAP EPS of $8.26 reflects minimal adjustment, a clean quarter with no major one-time charges. Gross margin reached 82.7%, consistent with Lilly's pharmaceutical-only business model at premium pricing.
Operating margin expanded to 46.3%, exceptional for any business and reflecting the high operating leverage embedded in drug revenues once R&D and manufacturing scale. Net margin of 37.4% confirms that Lilly is converting most of its revenue directly to profit at current volumes.
Mounjaro, tirzepatide for type 2 diabetes, is on track for its highest ever quarterly revenue. Zepbound, the obesity indication of the same molecule, is expanding across new approvals including sleep apnea and heart failure with preserved ejection fraction. Together, the two drugs are running at an annualized revenue rate that makes Lilly the fastest-growing large cap in the S&P 500 on a percentage basis.
Free cash flow on a trailing 12-month basis reached $13.58 billion. Cash on the balance sheet is $5.28 billion. Net debt of $38.1 billion reflects Lilly's $18 billion United States manufacturing investment. New facilities in Indiana, North Carolina, and Wisconsin designed to close the supply gap that capped 2024 and early 2025 revenue growth.
Full year 2026 revenue guidance stands at $82.1 billion. Full year 2026 EPS estimate is $34.52. Trailing 12-month PE is 33.1 times. Forward PE of 27.1 times reflects analyst expectations for continued earnings acceleration as manufacturing capacity comes online and Zepbound volumes ramp.
Price to book of 26.8 times and EV to EBITDA of 27.9 times reflect the growth premium the market assigns to Lilly. The valuation compresses meaningfully on a 2 to 3 year forward basis if GLP-1 revenue compounds as projected. No stock-based dilution concerns. Share count has remained stable.
The 55% revenue growth rate is not a one-quarter anomaly. It follows 45% growth in Q4 2025 and 36% in Q3 2025, a clear acceleration trend. The rate is driven by volume, not price. Zepbound is gaining patients on new indications. Mounjaro is expanding globally into markets where it was previously unavailable or constrained by supply.
Analyst consensus heading into Q1 2026 was 34 buy ratings, 8 holds, and 2 sells. The average price target of $1,287 represents 38% upside from the current $934 price. That spread between price and target is unusually wide for a mega-cap, signaling that analysts believe the stock has not fully priced in the multi-year GLP-1 opportunity.
Morgan Stanley and Goldman Sachs both carry overweight ratings with targets above $1,200. Their thesis centers on orforglipron, Lilly's oral GLP-1 in phase 3 clinical trials. An oral GLP-1 that matches injectable efficacy would represent the single largest addressable market expansion in pharmaceutical history, opening the obesity treatment market to patients unwilling or unable to self-inject.
The 2 sell ratings reflect valuation discipline rather than fundamental skepticism. Both sellers acknowledge the GLP-1 opportunity, but argue the current 27 times forward PE leaves no margin of safety if supply constraints or competitive dynamics shift against Lilly in the next 12 months. Their price targets are near $900, roughly flat to current price.
The consensus watch item for Q2 2026 is Zepbound prescription volume growth relative to manufacturing output. Wall Street models assume the new Indiana and Wisconsin facilities contribute meaningfully in the second half of 2026. If output misses capacity ramp schedules, revenue guidance will come under pressure despite the demand signal remaining strong.
The bull case for Lilly is a once-in-a-generation pharmaceutical platform. Tirzepatide is not a single-indication drug. It is a metabolic intervention molecule with benefits across obesity, diabetes, sleep apnea, heart failure, and potentially non-alcoholic steatohepatitis. Each new FDA indication opens an entirely new patient population. Management is running 40-plus clinical programs across the tirzepatide franchise alone.
The $18 billion manufacturing investment is a moat, not a cost center. Once the new Indiana and Wisconsin facilities reach full capacity, Lilly's marginal cost per unit of tirzepatide declines, while its ability to serve global demand increases dramatically. Competitors cannot replicate this manufacturing infrastructure in less than 5 years. First-mover scale in GLP-1 manufacturing is a durable competitive advantage independent of patent protection timelines.
The bear case starts with multiple compression. At 27 times forward earnings, Lilly requires flawless execution, no supply disruptions, no clinical failures, no competitive breakthroughs for multiple years. Any single negative catalyst could compress the valuation meaningfully. The stock has doubled in 18 months. Mean reversion risk is real, even if fundamentals remain intact.
Novo Nordisk is not standing still. Semaglutide's next-generation formulations, particularly higher-dose CagriSema and oral semaglutide, could match or exceed tirzepatide efficacy in head-to-head trials. If Novo achieves parity on efficacy and undercuts on price, Lilly's premium valuation erodes rapidly. The GLP-1 duopoly could become a commodity market faster than current models assume.
IRA Medicare price negotiation is a structural headwind. Mounjaro is eligible for negotiation in the 2028 to 2030 window. A 25% negotiated price reduction on a drug running at $30+ billion in annualized revenue is a $9 billion annual headwind. Lilly's current valuation does not reflect this risk adequately in the bull scenario.
Net debt of $38.1 billion from the manufacturing build-out limits financial flexibility. If GLP-1 revenue growth decelerates before the facilities reach full utilization, Lilly faces a leverage problem in a rising interest rate environment. The $38 billion is manageable at current revenue. It is not manageable if revenue misses by 30%.
The GLP-1 peer comparison is straightforward. Lilly versus Novo Nordisk. Novo trades at 22 times forward earnings, a 5-point discount to Lilly's 27 times. The discount reflects Novo's greater dependence on semaglutide versus tirzepatide's broader metabolic applications. Both companies have duopoly pricing power in GLP-1, a structural advantage not available to any other pharmaceutical company.
Versus traditional large-cap pharma peers, the valuation premium is stark. Merck trades at 14 times forward earnings with Keytruda as its dominant asset. AbbVie trades at 18 times with Skyrizi and Rinvoq. Johnson & Johnson trades at 15 times. Lilly's 27 times premium is only justifiable if GLP-1 revenue compounds at 30+% annually for 3 to 5 more years, which current data supports.
AstraZeneca is the pipeline comparison. AstraZeneca trades at 21 times forward earnings and has a comparable pipeline depth in oncology. Lilly's premium over AstraZeneca reflects the market's view that GLP-1 obesity is a larger opportunity than oncology on a 5-year horizon, a defensible but not guaranteed assumption.
Pfizer at 11 times forward earnings is the cautionary comparison. Pfizer had COVID vaccine-era revenue that looked similar to Lilly's GLP-1 ramp, concentrated, high margin, and fast-growing. Then it collapsed. Bulls argue GLP-1 is a chronic maintenance drug with recurring prescriptions rather than a one-cycle windfall. The distinction matters significantly for long-term revenue modeling.
Pre-earnings options market priced an 8 to 12% implied move for Lilly, reflecting high conviction that results would be materially above or below expectations. The actual move of 10.5% landed squarely inside the implied range. The options market was well calibrated to Lilly's earnings volatility, which has been above average for a mega cap given the sensitivity of GLP-1 revenue to supply and volume data.
Post-earnings call activity was heavily tilted toward the upside. Institutional buyers concentrated on the $900 to $1,100 strike range for September and December expiry. The positioning reflects confidence that Lilly's manufacturing ramp in the second half of 2026 will drive another leg of revenue acceleration, with the potential for a guidance raise in Q2 or Q3.
Insider activity at Lilly is limited to standard executive compensation. CEO David Ricks has not engaged in material open market selling. The absence of insider selling at these valuation levels, stock up over 200% in 3 years, is notable. Executives retaining shares through vesting signals confidence that internal projections support current valuations.
Short interest in Lilly is low at approximately 1.2% of float. Low short interest combined with heavy institutional ownership creates a potential squeeze dynamic if orforglipron phase 3 data exceeds expectations. Lilly's options skew is tilted toward calls, unusual for a megacap and reflecting the asymmetric upside optionality embedded in the oral GLP-1 pipeline.
Lilly delivered $19.8 billion in revenue, up 55%, adjusted EPS of $8.55 beating estimates. Zepbound and Mounjaro are the dominant GLP-1 franchise. Watch manufacturing ramp and orforglipron phase 3 data as the next catalysts.
Risks are real. 27 times forward PE, Novo competition, IRA pricing in 2028, analyst target of 1,287 implies 38% upside. Financial data and charts are sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making any investment decisions. Thanks for listening to Charged Alpha. If this was useful, subscribe and leave a review. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.